Hi, David here, CEO and founder of the Freedom Founders Mastermind community. What about friends and family investments? What do I mean? Look, everybody wants to get in on the latest, greatest, whatever the investment is that you have fear of missing out. FOMO, right? It's just human nature. Whatever's happening in the markets, whether that's in Wall Street, that's in crypto, that's in tech stocks, that's in real estate, you name it. If somebody's done it and claiming a big victory, then it's like, I want to get in there too. And particularly when it's friends and family, because we feel like, well, they're no better than we are. Why are they getting in on something? There must be something I don't know. I should jump in too, because I don't want to be back here in the back seat of the bus and not be able to brag about my returns. It's a normal condition. If you've ever felt that way, trust me, we've all been there. We've all jumped into things in that kind of euphoria, that exuberance, and found out later, like, I wish I hadn't. Well, what's a prime example? Bernie Madoff. That was a friends and family investment deal. Bernie Madoff made great claims of the kind of returns that he could get for his investors. And a lot of very, very well-to-do, well-educated people that are celebrities through the friends and family network, because somebody said to their group, hey, this guy over here, he's a genius because I'm getting these kind of returns. And everybody's like, well, I want into some of that too. You can read about it. Google the people who got in on that. It happens. So how do you protect yourself from that? Well, number one, you've got to understand what it is you're investing in. Yeah, I know it's hard to do, right? It's like, well, I can't be an expert in all areas of investing. No, you can't. And that's why you need to choose an arena and find some things that you really can feel good about. Outside of just investing in index funds or ETFs, which maybe that's a part of your overall portfolio. But if you really want to have more control over your money, which is what I've always wanted to do, then I've got to learn about the things I want to invest in. Today, I want to be more passive in my investments. There's a time to be active. Maybe when you're younger, you've got more time than money and you can get on the ground floor and you can be a part of finding deal flow, managing it perhaps, or being involved in that. And that's good when you're young. But when you're at a certain point in life, you don't want to be doing that because you value your time a lot, and as I do. So I've got to find, number one, the right people. Right people. It's not friends and family. It's do I have a network of people that I have had the opportunity to spend time with, build relationships with, and what level of vetting, vetting, underwriting people am I able to do? It's hard to do with friends and family because they're separated from whatever the investment is. They don't know. They just put some money in something, and because of the luck of the market going up, as it's been doing for the last 15 years, they made money and they feel good. They want to do it again. They're excited. They want to tell you about it too. And yet you've got to be more discerning in the marketplace today. We're in a different time frame altogether than what we had the last 15 years. It's totally different right now. Yet there's still exuberance in the marketplace because there's still a lot of liquidity that came out of the 2020, 2021, 2022 pandemic stimulus money that was blown out of the water with 8 or 9 trillions of dollars that were digitally credit expanded into the marketplace. I mean, it's fiat currency that just was stuffed into everybody's hands. And a lot of that money went right to the top of the asset classes that you and I are privileged to be able to invest in, but most of mainstream America cannot. And yet the people who are typically about syndicating capital in syndications or funds, taking it from people like us with the intention of doing good works with it, which is what we all want, they are going to need more and more of our capital because why? The credit markets are tightening up. The underwriting for bank institutional financing, which most of them got to rely on in past years. And it was good because the cost of capital, interest rates were very, very low for many, many years coming out of the 2008 great financial crisis. Very, very low rates. But today, that's different. On a magnitude of 500%. That's a huge discrepancy. And yet many of those people that did well in the earlier times with their models are finding the headwinds to be heavy right now. And we're just at the tipping point of where I think in many cases the commercial real estate market is going into the correction mode. We've seen it on the forefront with office. We're starting to see it in some of the other commercial spaces. I think this year is going to be a great roll-off. So you've got to be careful about who you give your money to. And just because they've had a great track record in the past, I'm not saying that they're bad. I'm not saying that they're running Ponzi schemes. I'm just saying, how do you know? How do you know? Everybody talks a good talk. Everybody's friendly and happy and accessible until they're not. I've seen this too many times with people that I thought were good people who I thought carried a strong track record in their field, and we find out, as Warren Buffett says, when the tide goes out, you find out who's been swimming with no clothes on. And there's many people. I would just guess, and this is my guess, that probably 70%, 70% of the people who raise capital for their funds and syndications are running deficient operations. They don't really know what they don't know. Their accounting, financial dashboards, and accounting management is usually subpar. I've seen some that's ridiculously subpar. How can they manage your money in an operational capacity in investments if they don't even have the basics in place? They got away with it. They got away with it when the markets had cheap money, and there was just always someone else to buy them out, even if they had poor financials. And as an investor, you never knew it, because if you got your money in a decent return, like, well, everybody's good, right? No harm, no foul. It's different now. Be very, very careful. You don't know the questions to ask. Your financial advisor doesn't know the questions to ask. Your attorney and your CPA. You've got to be able to do a deep dive. Otherwise, you're putting your money at risk. Many people tell me, well, what do I do, David? Unless you're in a position to do a deep dive, or you're connected with people who can help you do that, or as a community you do that, I would say play risk off, meaning don't go into those things right now. If you took a year, 18 months off to watch what the market does and wait till the market corrects, your chances of investing then, even without deeper due diligence, is far greater. Why? Because those who have been swimming naked will be flushed out of the market. Ideally, not with your money, somebody else's money. And then you wait to see who's standing strong on the other side. Those are often, not always, but often the people you want to invest with. So that's a broad stroke. For me personally, before I invest my money with anybody, I want to know what their financial accounting is about. I want to know their back office. Certainly, I'm looking at their track record, but not relying on the track record, because I want to know how they're set up to go into the headwinds that we have today, the higher interest rates, the cost of capital, and the credit underwriting for the bank loans that they've used. What kind of leverage are they using? What are the terms on that leverage? And what's the loan to value they're getting? Many of these syndicators and fund managers have been riding and leveraging the equity capital from people like us, riding that. And again, as long as the deal runs fine, I'm okay. But today, I would make sure that anybody you're investing money with has at least, this is a minimum, 5% of their own hard money, not money from fees and commissions, but their own hard money in a deal. I like to see 10% today. If they can't do that, they're not willing to put enough of their own capital in the deal, then why would you want to invest with them? These are questions that I know many of you are not asking. And if you're not asking these questions, you're putting your money at risk. A lot of these syndicators are people who got used to the quick turn of the deal, right? And they make a lot of money on the acquisition fees on the front end. Nothing illegal. They all disclose it. We take this much percentage. We take this much for percentage for loan guarantees. We take this much money for assets under management, and then you hire another management company. So they are taking overrides over your money before you get a dime. Again, it's not illegal. It's in their operating agreement. You've got to read it and understand what they're doing. If the deal goes fine, then nobody cares, right? The problem is the deals are not going fine today, and the old models that they've been used to using don't work in the current marketplace. So they built an infrastructure where they got used to having to turn properties quickly, and now they don't turn fast. But they still need your money. Where are they going to put it? Probably in more marginal deals, just so they can collect the fees and keep the lights on, but your money's the ones at risk. If they don't put very much or any money in it, they've got no risk at all. That is not a place you want to be playing ball. Just trust me on this. I've been through this. I've seen it. I see behind the curtains all the time of what these people are doing. And again, most of them don't have bad intentions. Most of them have good intentions. They just don't know what they don't know.